The minimum credit score for a personal loan can vary depending on where you look. Here's what you should know about credit scores and personal loans before you apply. Unsecured personal loans can be used for a variety of financial purposes, from consolidating high-interest credit card debt, to finally finishing home improvement projects around the home, or working through an emergency. With an unsecured personal loan, you receive a lump sum from the lender, but you do not have to offer collateral, such as a vehicle or real estate, to borrow the money. However, without collateral, the lender relies heavily on your creditworthiness as a borrower and your income. For this reason, it's important to understand the impact your credit score has on obtaining an unsecured personal loan and what you should know about credit scores and personal loans before you apply. Average credit score range needed for an unsecured personal loan. The average credit score range needed to obtain an unsecured personal loan depends on the lender. The rates for personal loans depend on a variety of factors, including your credit score, your credit history, the length of the loan you're applying for, and other factors. However, you can expect the interest rates to be lower if you have a more favorable credit score. While the exact interest rate of your unsecured personal loan depends on your personal financial factors, according to the National Credit Union Administration in September 2022, the average interest rate for a 36-month unsecured personal loan with a bank was 10.16% and the national average rate with a credit union was 9.15%. Does getting an unsecured personal loan affect my credit? Yes, getting an unsecured personal loan can affect your credit in a couple of ways. During the application process. For starters, when you submit an application to the lender for an unsecured personal loan, the lender may conduct what's called a hard credit pull or inquiry. This inquiry is visible on your credit report for up to 2 years and anyone who has access to your report will see it. A hard inquiry can bring your credit score down by about 5 points, but the impact typically lessens after the first 6 months of an inquiry. Lenders look to see how many hard inquiries you have on your report because it signals to them that you may be applying for too much credit from too many other sources. The more inquiries the lender sees might indicate you're a higher risk borrower. When you take out an unsecured personal loan, once you're approved and receive funds from an unsecured personal loan, the activity will be visible on your credit report. Your repayment history will be recorded every 30 days, so it's vital to make on-time payments as they may positively impact your credit score. Taking on a loan also impacts your credit mix. An installment loan is a different type of borrowing tool than revolving credit, such as with a credit card. You may positively impact your score by having a mix of both installment and revolving credit, if you make payments on time. Taking on an unsecured personal loan can have a positive or negative impact on your credit score, which means you should be fully aware of both the benefits and risks before you enter into an agreement. Pros and cons of unsecured personal loans. Unsecured personal loans have a few advantages, including, but not limited to, flexibility. You can use the lump sum for virtually anything, which gives you greater flexibility with the funds. No collateral. With an unsecured loan, you don't have to worry about using a car, title, or real estate, so these items can't be taken away if you are unable to make payments. Lower interest rates. If you look at the national average of rates for personal loans, you'll notice it is much lower than credit card interest rates. The national average for a bank credit card currently was 13.05% as of September 2022. Paying less in interest means the overall cost of your loan should be less. Fast funding. Some lenders are able to provide a lump sum as soon as the same day you're approved. Typically, the funding times for personal loans are quicker than other borrowing options. But personal loans have drawbacks too, including, but not limited to, higher fees. Unsecured personal loans usually include higher fees, such as origination fees and prepayment penalties. These all add to the overall cost of the loan, so it's important to compare fees among lenders. Strict eligibility requirements. Because you're not using collateral, an unsecured personal loan has strict eligibility requirements, such as your credit score and income. Impacts monthly budget. You'll have to make a payment each month until the loan is paid off, which can have a negative impact on your monthly finances if you're not careful. Unlike a credit card where you have an option to pay a minimum, your payment will be fixed. Increased debt. You're taking on additional debt by taking out an unsecured personal loan, which impacts both your credit profile and finances. Options for personal loans. If you have a low credit score. If you're concerned your low credit score will keep you from getting an unsecured personal loan, you do have other options. Use a cosigner. Some lenders will allow a cosigner with the personal loan, which means they're responsible for payments if you're unable to make them. If they have a stronger credit score, it may increase your chances of approval. Work with a lender who specializes in low credit scores. Some lenders will accept lower credit scores by considering other factors besides your credit profile. Consider other borrowing alternatives. You may also have access to other borrowing options, such as a 0% APR introductory offer credit card or a personal line of credit from your current financial institution. You may even consider peer-to-peer loans, which are funds provided by individual investors, instead of a financial institution.